Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by CommercialAgentSuccess.com. Check it out. It is the ultimate and commercial broker training for experienced agent. The website is CommercialAgentSuccess.com. Well, we have a special show for you today. Every year, PwC puts out a report with Urban Land Institute called Emerging Trends in Real Estate, and they've been doing it for years. It's a credible report. You really got to check it out. We're going to talk about some of the highlights from this today and some takeaways to add value to your planning for the year ahead. Please welcome my guests. I have Tim Bodner here. He is Real Estate Deals Leader with PwC, and we have Byron Carlock. He's Real Estate Practice Leader with PwC here in Studio One. Gentlemen, so good to see you.
Thank you, Michael. Good to see you.
First of all, just remind our audience about this report, how long you've been doing it, and how is this done? How is this created?
So this is the 43rd year, and it's a survey-based sentiment report on how people are thinking about the coming year, 2023. Interestingly, this year, the survey opened in July and closed in September, and you could see a steady downward trend in the sentiment as we came closer to publication date. It was launched last week in Dallas at the fall meeting of the Urban Land Institute.
Interesting. And you have some top 10 takeaways here that we're going to talk about and catch on some other items that are in this report. We'll have a link to the report at the show website, CREshow.com, if you want to check out the report while you're listening or watching. And number one was normalizing property market fundamentals. Tell us about that.
I think, Michael, when you look across real estate operating fundamentals, transaction volume, trends in cap rates, we've been in a period of such a favorable period for so long that things are starting to come back to kind of what they were some time ago. And I think our view is in many respects that's healthy for the markets.
Yeah, I mean, we can't have interest-free money, right, forever. Right. That's not really a good situation for us to be in, is it?
No, and it's going to take a while to burn off some of the stimulus spending that has inflated the economy and certainly inflated asset values. So I think normalization is an important step to healing the industry, taking some of the air out of the tires, and then moving toward a new state of normalcy.
Yeah, and when you think about the analysts and other folks in this industry, I guess there's a lot of folks that really haven't seen normal rates.
Well, think about it. I mean, we've really had healthy growth in the industry since the great financial crisis, and we've had discipline in the capital markets that have kept us from overbuilding. And going into this downturn, it's very interesting. We've still got great demand characteristics in most product types. We'll talk about office later. That's one where there's not as much demand, but still healthy demand and lots of dry powder. I'm not sure we've gone into a downturn like this with so much dry powder. And thirdly, when the Fed increases rates in 75 basis increments, as they did yesterday, they usually come down in 15s and 20s and 25s. So that alone tells us we're in for a period of 2.5 to 3 years of renormalizing.
Yeah. So, with this rapid increase in interest rates, to your point on normalization, cap rates have to change, right? They're not going to go, they're not going to match the interest rate changes, but they have to change, right?
Yeah, they do have to change. I think what we're seeing for the most part is that, the movements have been kind of small to take 15, 25 basis points in sectors like multifamily and logistics and office, a little bit wider than that in some cases, 75 to 100 basis points, but it's still selective, and the bid is still a little bit hard to find in many markets, and so we'll see. But there are starting to be cap rate adjustments being observed in the activity.
Yeah, and Michael, if you look at periods of downturn in the past, there's always a period of what we call the season of price discovery. Right now, we're seeing that bid-ask spread in the 5 to 20% range, but not a lot of transactions. The appraisers are really in a conundrum right now because there are not enough data points to justify downward valuations for the asset managers. So there's this appraisal lag that waits until there's enough transactions to support a downward valuation. valuation. But I think in our gut, we're feeling it through this period of the bid-ask spread being in that range of 5 to 20%, depending on the asset type, the market, and the condition of the property. The better stuff, the flight to quality, is that the stuff that is trading, and the price diminution is not that great.
That's right.
Yeah, we're seeing the price discovery too at our shop, with folks really trying to figure out kind of where we're landing, and we're seeing the same thing. Very small changes in cap rates in industrial and multifamily, but larger when you get to other property types. And I was speaking at an appraisal convention a few weeks ago, and that was their question. They were concerned about, hey, what do we do when a bank or someone comes to us for an appraisal and our comps are with old interest rate closed loans, right? And yeah, so I think one of the things that I told them is, hey, what, you got to talk to the people on the front line doing the deals, and we're seeing, to give an example, we had a portfolio we looked at where we would have went out at a 7 cap, 6 or 8 months ago, and we wouldn't go out unless it was an 8 cap today. For office. So I think, as these sales close, we'll start having some comps pretty quickly here, because, talking about volume being down, we're seeing volume down about 50% on trades. But that's maybe not all that bad when you think about how ferocious 2021 was. Correct. Right? That's with the changes and potential changes we had in 1031s and tax rates. There was a lot of
2021 was a very significant volume year. When you look at it over the last 10 or 15 years, if you looked at, as of we'll get kind of the third quarter numbers here finalized in the next couple weeks, but through kind of the second quarter and half of the third quarter, we were about proximate to 2020 in the aggregate across asset classes in terms of total volume. So it's down, but it's down relative to a very high benchmark.
And so much of 2021, as you pointed out, was tax driven out of fear that there were going to be major changes to the legislation that didn't necessarily happen. But there's not any pending legislation this year that would necessarily push transactions, and there's this bid-ask spread in the price discovery.
What would you guys say to folks that maybe weren't as heavy into real estate before the Great Recession? And I don't know why you're calling it great. I didn't think it was that great, Byron. What would you say to those folks when they've been in the business for 10 years?
Well, if you think about this season of inflation we're having, real estate has always been the best inflation hedge. So those that have been under-allocated in real estate are really thinking their allocations for hard assets. And I think that's probably a good time to be making investments, and frankly at better prices than they would have gotten 1 and 2 years ago. So I'm a fan of real estate as an inflation hedge. Many of the institutions are unable to increase their allocations even because they want to, because of the denominator effect on their equity and bond investments. So we're going to see those who have capital to deploy perhaps shy away from the liquid markets and look at real estate as an appropriate inflation hedge.
Yeah, I think we've talked about this in other sessions, Michael, but one of the things we look at across sectors at PwC is the significant shift in power occurring from public markets to private markets. And so certainly what Byron's talking about in terms of the denominator effect with pensions and private equity is real, but there is a significant widening of the private capital universe where high net worth individuals, family offices are really starting to look at going aggressively into real estate, particularly mixed use real estate is an example where we're seeing a lot of that come through.
Yeah, it's a great time to buy. I think when people aren't in real estate ask me about the market and timing, so we'll look at, if you're not in real estate, if you're at a cocktail party and everybody's talking about how great the market is and they're flipping contracts and all that, you should be selling. And if they're talking about how tough the market is and how rough everything is, you should be buying.
Yeah, this will be a season that's appropriate for what we call rescue capital.
Right.
Yeah.
All right, well, let's go to number 2, and that was structural shifts, or is structural shifts. This pandemic has kind of changed lifestyles for a lot of people, right, and the way business is done.
Yeah, I think the biggest thing here, Michael, that we observed is just the shift in how people are living, working, and playing. The idea where people want to commute an hour, 2 hours to get into the office in certain markets around the world is kind of going away. And there's this idea that they want to be proximate to where they work. They want to be around their friends. They want to be close to to entertainment, and that's having a significant impact on the office market and in particular, but it's also driving activity in other sectors like multifamily and some of the retail and the like that we're observing.
Yeah.
Yeah, it truly changed the way we live. And so we're seeing the boomerang back to the cities. Most of our gateway cities have rents that are at or above the pre-pandemic levels, but people are going in 3 days a week generally and living further out so that commute is not as painful if you're going in 3 days a week versus 5 days a week. And frankly, we've become a society that values that flexibility. It's going to be interesting to see if that dynamic changes. We're just now beginning to see some shifts where employers are demanding folks to come back. It'll be interesting to see if they do. Mm-hmm. And but I think the 3 day a week in the office, 2 days work from home seems to be the magic number right now.
Yeah, and I'll just give the solution to the entire world right now from Michael Bull. All right, here it is. It's a 4 day week. Let's compromise, right? So we all have the benefits of being together, right, in our office environments and all the benefits to us as employees and employers. But hey, let's give Fridays off. I think I get that much done on Fridays, right?
Well, last week I had Gensler on stage at the ULI conference talking about changed office behaviors, changed ways that we're using space. And of course, Gensler's an architecture firm, and they are spending their time redesigning workforce environments. Mm-hmm. And they showed us some really crazy, interesting examples of things they're doing for folks to create visitation to the office as a destination, not an obligation, which I thought was an interesting phrase. Yeah. And then last week I was with an office landlord who said if you go down to his loading dock, it looks more like a furniture store than an office building, and people were literally throwing dividers and cubicles into the dumpster, replacing them with sofas, coffee tables, lamps, like living room environments, so that when you're in the office, it's collaborative time for mentoring, training, whiteboarding, business planning, product introduction, things that really require one-on-one interaction. Yeah. And then heads down work, it's okay if you do it from home.
Yeah, that's right. Well, you're also seeing it too, Byron. I think we see this across our client base in terms of what's happening in the hospitality industry, and there still is significant momentum in leisure related travel, and the blurring of the line between business related travel and personal travel, and what some have called leisure, and the conference travel and things like that. It's still business travel, still slow to come back. So that's another kind of structural shift that we focus on, and when we think about what's coming out of the pandemic, that's interesting, and it kind of combines with what we're talking about on the office.
Yeah, I sure have enjoyed conferences coming back and speaking at events and being around the people. It's like, if you think about it, if you were the richest man in the world and you had everything you ever wanted, but you were by yourself,
be a little lonely, wouldn't it?
It would be terrible, right? It's the people around us that make life interesting and fun. Well, let's talk about number 3, and it's really about allocation, right? Where's the equity going? What did you guys see there?
Yeah, well, I think when you look at overall kind of capital flows, there is a slowdown in capital coming in to real estate. Byron touched on it recently, but there also are a lot of market participants that are kind of moving to the sidelines, and the most active bid right now is the all cash bid. And there's certain pockets of investors, particularly if you look at some of the foreign investors from places in Asia and the Middle East, that are really aggressively kind of being on their front foot in this market because they view it as an advantage.
And do you expect foreign investment to increase a year ahead?
We're seeing interesting flows from ultra-high net worth families around the world, seeing the U.S. as a safe investment haven. Mm-hmm. They're also desirous of placing all cash. As you know, the debt markets have really constrained in the last 60 to 75 days. Underwriting is much tighter. If you want a loan, it's under much stricter terms. So the all-cash buyer obviously has an advantage, and that ultra-high net worth family office from around the world, I think there's 7,600 of them now that are looking for those kind of investments.
Yeah, it's a great time really to have dry powder if there's less buyers that you're competing with, right? Whether you're a business looking to lease or acquire space, or an investor, right? It's an incredible time. Well, let's jump to number 4, which was a big one to our economy, right? And that's housing. It seems like you watch housing and you watch the economy follow it in commercial real estate. What do you guys see there as far as housing and affordability?
Yeah, I mean the macro point, Michael, is that housing affordability is still an issue, and even in those markets that in certain pockets of the Sun Belt that we saw a lot of population migration, are starting to feel that too. And so there is a an issue that needs to be addressed pervasively across the U.S. when it comes to housing.
Yeah, some skeptics are saying the American dream is gone, that home ownership is no longer available. I think there's still the dream. I think nearly 30 million young people still living at home that would be normally in household formation years. That we are becoming a more renter-dominated society. The renting lifestyle allows for flexibility and transience without the burden of having to sell a home. And so we are seeing that preference right now. I don't think the American dream has gone away. As we look at this intergenerational wealth transfer down to the millennials and Gen Z, the bulk of that wealth is the result of the savings, the forced savings of a 30-year self-amortizing mortgage. And so there is still the desire for home ownership and that forced savings account, if you will, but it had become very expensive. And so it's not a bad thing that pricing might be coming off in some of our cities. However, in our major cities, pricing is still requiring 45 to 50% and sometimes even more of one's paycheck to own. And that's that dynamic makes it very tough. We underproduced housing for the last 10 years, and we may be between, let's say 5 million units short. The growth of the build to rent phenomena is worth watching because that does give a bridge between the higher density multifamily and the path to single family home ownership.
I think your point is an interesting one because there's also a lot of innovation happening in the residential ecosystem to address kind of what Byron's talking about, where whether you're a renter or you're trying to become an owner, where you have the ability to build equity and kind of create wealth that's kind of becoming an issue because of this housing affordability thing. The other thing that was touched on, and Byron's right to call it out, is the institutionalization of the single family residential sector as a sector, coming out of the Great Recession was viewed as an unrealistic business model. I think people have proven it. And what is happening for sure still right now is that there is a lot of the share that institutional investors have of overall transaction activity is growing.
Yeah.
And we expect it to grow further.
Yeah, it's interesting when you look at the growth of build for rent, these homes, is that you really can't put a swing set, your own private swing set at your apartment complex. Right? If you're going to grow a family, you might want that single family lifestyle. Well, what does this affordability, these rising rates for homes, and the affordability issue of buying homes, what does that mean for the multifamily world? That when we've had incredible rent increases for the last several years, should we expect that to continue?
Look, I think you're seeing it in many markets around the U.S. where the rent increases on new and renewal leases is starting to kind of soften a bit and come down for a whole host of reasons, including one that Byron mentioned, where it's gotten to be a point where it's such a significant portion of people's paychecks that it can't continue to go up at this pace forever. So there's favorable tailwinds overall for multifamily, but the pace of the increases, I think is normalizing, to go back to the first theme, and it's
certainly
not gonna,
leveling out.
Yeah.
But there's been double-digit rent growth, and I don't think that's sustainable. But we do have supply shortages that are going to have to be addressed. I'm hoping that some of the softness in office may lead to conversion of facilities for buildings where that's conducive. Some buildings it's not conducive, but hopefully that will add to the supply. The cost elements are beginning to moderate. The supply chain is beginning to get over its year of 2 years of backlog. Lumber prices have already come down. Hopefully concrete and steel will a bit as well, and that will be an appropriate incentive, along with some municipal incentives like were announced in Chicago last week, to encourage developers to look at conversions with set-asides for affordable, especially for service workers in the 80% of median income range, will alleviate some of these supply constraints.
Yeah. All right. Well, so we're number 5, which will close out this first segment of this show. And at number 5 is give me quality, give me niche. Tell us about that.
Look, I think it's the first part of that give me quality is really focused on the office sector. The best quality office buildings that have ESG certifications, there's incredible demand, and the rent increases that people are seeing in there are quite strong. The Class B suburban office, that's where there's a little bit more of a structural issue that needs to be addressed, and it gets at the heart of what Byron was just referring to, where people need to look at that space and figure out what the higher or best use for that piece of real estate is. The second part of it is really a continuation of what we've seen for some time, which is the widening of what people consider to be investable real estate asset classes. So we've seen for some time a significant bid in data centers, self-storage, medical office, student housing, and that's really just a continuation of it. And interestingly enough, we actually think that could accelerate because of some things that are happening around the margins, such as the index is kind of including kind of a plus component to it, where they're actually starting to track what the performance is in these asset classes, which historically wasn't the case.
Sure, and I would add life sciences to that. The new innovations in multifamily to include co-location apartments, where traditional multifamily is now taking lessons from student housing, so that you're renting a room instead of a whole apartment. So there's the niche side is worth watching. It's a small component of the four major food groups historically of office, industrial, multifamily, and retail. But these niches are seeing big growth and big allocations.
Yeah, that co-living apartment rentals industry, that was really interesting to me. We did our first show on that. I'm like, wow, and they've got it down, right? If student housing can do it, the regular housing can do it, and it can help with affordability. And getting back to giving equality, if you're employees and you're an employer and you value having people together and the benefits for them in your company, then you want that quality, right? You want that space that brings people in and has the nice furniture and the fresh flowers and everything. Right?
Amenities, service. The hospitality industry has taught us a lot. That's got application across all the product categories. Retail especially, the retail that offers an experience is doing pretty well.
Yeah, that's true. All right, well, that's the top 5. We're going to take a quick break, and we'll be right back, and we'll go to the number 6 through 10. So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. We'll be right back. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert-level commercial real estate broker training. Cloud Access 1, up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.